Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk to you about today are a couple of issues regarding the converting trusts and a little progress update on that, if you will. And also something of an admonition that, at a time when so many of our holdings have pushed through our long-standing buy targets, to be patient. Certainly we've seen some huge ups and downs in this group, particularly since we started the publication back in the middle part of 2004. Tremendous ups and downs for many reasons. Investors in the U.S. have learned that Canadian investments are generally more volatile than U.S. investments because they're priced in Canadian dollars. So even the safest things out there, the least volatile things, if the Canadian dollar has a bounce, which it did in 2008, these things come along with it. I think the Canadian dollar is going to be a very positive force for these investments, as it has been for the last year and a half. There's just a lot of reasons to expect more appreciation against the dollar, even though we're basically at parity, and even though Canadian government would certainly like to see the rise be slow to protect its own industries. But the fiscal situations there is much better. They're headed for balanced budgets by the middle of the decade. I don't know when the U.S. can hope to have a similar positive thing happen, but certainly a better fiscal situation. The banking system's much stronger. All you have to do is look at the comparative earnings between, say, Bank of Scotiabank and Regions Financial or some other U.S. bank. They're in much better shape on that score. Their balance of trade is very strong. A lot of that's to do with natural resources. They have a market in China now, which is picking up the slack and then some from the still weak environment in the United States. And the price of oil, which the Canadian dollar has tended to track pretty closely. Again, looking very strong around the world in light of rising demand in the developing world, recovering demand in the developed world. So all these things, I think, mean a better Canadian dollar, but investors need to be prepared for that going forward. And that's another reason, again, to be conservative and to utilize the buy targets, because what goes up can come down, and even something that looks like it will never hit our buy target again may come back and hit it again. Now, that said, buy targets can change, particularly if a company is growing, if it's demonstrating that it's worth a higher share price, we'll raise that buy target. That's really the only way that we do that. And we've seen that it has happened for several of our holdings, and with third quarter earnings coming on, I fully expect to see more of that happening. One company or two companies actually that I just mentioned in a recent flash alert that hopefully you've all read right now. One, Atlantic Power, which did a series of equity offerings, a major stock issue as well as a convertible bond issue in the latter part of October, but immediately followed that up with very accretive acquisitions. A lot of people, when they see a capital issued, when they see stock issued, they just assume dilution. They assume trouble. They assume that dividends are at risk. And in fact, that's what a number of our readers actually contacted us asking that question. Well, Atlantic pretty much laid those concerns to rest, put that money to work immediately. They're accretive deals. Again, this is the lowest cost capital they've ever been able to raise, and both for debt as well as for equity. And they've, again, put it to work. Very low risk projects, in this case, beefing up their biomass power plant stakes, with the money that was earned from the offering. So, this is what you want to see. You want to see companies issuing low-cost capital, putting it to work, increasing cash flow, and thereby increasing distributions, or at least distribution safety for the long term. And that's what Atlantic's done. So we have, if you'll notice in the flash alert, we have raised the buy target for investors who have not bought in already. So something to look at there. Also, Canfor Pulp Income Fund, which we just added to the portfolio as an aggressive holding. Very aggressive. It's certainly the most aggressive company I've ever recommended in CE on the basis of yield. But it's and in fact, as I've warned investors, that's not the yield of almost 20% you see right now is almost certainly not going to last into 2011 when they convert to corporation. Why? Well, because they're going to start paying taxes, and in fact, management has already told us that somewhere between 25 and 30% will be the effective tax rate. The other reason is that the other reason to expect a dividend cut is the possibility for softening conditions in softwood pulp markets, which the company depends on for revenue, and a toughening of the market for, or tightening of the market for wood waste, which it depends on for processing. And part of the reason there is just because some of the higher cost competitors, Canfor is the lowest cost producer, some of the higher cost competitors are on the verge of re-entering the market. That means more supply, and it means greater strain on input supplies. So that could crimp margins as well. On the other hand, if you're looking at a company that has a yield of nearly 20%, there's a lot of room for cash flow to drop and then still pay an extremely high yield. So that's the basis of the recommendation. We're already well ahead in it. I think a number of investors took a look at probably the yield and bought in, and so it's really catapulted well above our buy target. But we are raising that buy target, and again, you can look in the flash alert to see the level. We would not pay above these raised buy targets, and the same goes for anything in the portfolios. Again, these are volatile. These stocks can be volatile, and you really don't do yourself any favors by chasing anything. So if you've been in these things all along, you know the score. If you're attracted to these things right now, be patient. That's the way you make money in any market. And while some of these yields may look attractive at prices above our buy targets, we're looking for total return here. And again, that's going to be enhanced by having a little patience and waiting for the market to come back to you. If it doesn't come back to you on a particular stock, there's many more out there that are trading below the buy targets. Focus on those. That's all I have to say today. Thanks for tuning in.